Hello, International Finance students. This is our final week, and I want to say that I've enjoyed working with our small cohort for the past 6 weeks. It's gone so quickly, so I hope you have a greater appreciation of international finance and have learned some things along the way. It's been enjoyable to listen to the current events and your forum posts as we go through this course. But to wrap up this last week, just 2 chapters, Chapter 15 on tax management, Chapter 16 on international trade financing. So I want to go over some items to help guide you through this week. When you think about tax management, honestly, the strategy is to try to reduce the tax liability. I'd say under the current administration, there's really a push to reduce the tax rate for corporations. We are one of the highest tax rates in the world. So from that perspective, it's a good thing. It's just now how do you pay for goods and services from the government expenditures. But the objective is to minimize the tax burden, and they go into some principles about tax morality, the idea of compliance with the tax laws and tax neutrality, trying to make decisions about how things should be taxed, whether foreign or abroad. And they look at 2 different types of tax systems: a worldwide approach, kind of based on the host country, and the territorial approach, which country has legal jurisdiction. So obviously, the goal for any firm is try to reduce tax liability to improve the earnings per share. But for a multinational, international firm, it gets a little bit more complex. So you're also going to read about things about the different types of taxes, whether direct or indirect. Direct, think of it applied to income. Indirect can be things such as value-added tax, consumption tax, excise tax, custom duties. So main thing I'd say with taxes, tax avoidance is good. It's legal. Tax evasion is bad. You may end up going to jail. So they have some different strategies. The textbook mentions about, allocation of debt, foreign tax credits, cross-crediting, and check the box, and transfer pricing. You think about these things, the allocation of debt, the benefit of getting the tax write-off from the debt interest expense. Foreign tax credits may help you avoid some double taxation. Transfer pricing, as we're maybe pricing goods to the host country. I could perhaps put them at a higher cost, but then it kind of gets some questions of efficiency. Cross-crediting, you look at that as matching deficits with credits. And check the boxes the textbook tells. Think of it more as about a different type of tiered ownership. So last, Chapter 16, international trade financing. How do we raise, I would say, short-term financing to help facilitate transactions? How do we help facilitate international trade exports and imports? They mentioned some key trade documents, a letter of credit. When I used to be at Sprint, we used to have to issue a lot of these. And the bill of lading, all the required documents, the receipt, the contract, the title, and those things. But other options, government export programs, also alternative trade financing, and last thing you'll read about is forward fading. It's financing with medium and long-term receivables, but usually that's a little bit more costly to do that type. So that's a pretty much wrap up of this week. So again, look forward to talking to you in the last forum discussion. I should have grades posted very shortly after our course ends. Everybody's doing quite well in the course, so just stay on top of things, wrap up those final forum discussions, homework, and you'll be good to go. Take care.